Format News Flash. Category News Flash. Word count. Send Sal Surfords your words. Estimated duration. Stur minutes last Tuesday. SoftBank Group reported the largest annual net income in the history of Japanese corporate finance. $33 billion. 5 trillion yen. A number so large that Japanese business reporters ran out of standard vocabulary for it.
What makes this story extraordinary is not just the size of the profit, it's where it came from. One company, one private bet, one man who refused to stop believing he was right even after losing $60 billion in the process.
On May 13th, SoftBank Group reported full-year earnings for the fiscal year ended March 31st. 2016 net income came in at 5.00 trillion yen, roughly $10 billion at current exchange rates. That's a 10 times increase year-on-year, and the first time any Japanese company has ever surpassed the 5 trillion yen threshold in a single fiscal year.
The quarterly number was even more striking. In the 3 months ending March 9, SoftBank earned 10 trillion yen against an average analyst estimate of 10.24 billion yen. That's a Mumbai C4% earnings surprise. Bloomberg called it a surprise profit jump. That understates things considerably.
SoftBank stock had already hit its daily limit up on May 7th. Tokyo Stock Exchange rules cap maximum single-day moves. When investors started piecing together what the numbers would look like, the Nikkei Itrat S-Wu rallied sharply that day on the news.
Almost all of this came from one source. SoftBank's Vision Fund reported a total investment gain of roughly $4 billion for the year. Of that, $4 billion came from a single position, OpenAI.
In October, OpenAI was valued at $40 billion. By March 31st, look that valuation had reached $40 billion. A go 10 yuan times increase in 5 months. SoftBank, which has committed $look billion to OpenAI and holds roughly a 1% stake, booked look trillion yen in valuation gains on that one position alone. That is 2% of the company's total investment gains for the year.
To understand what happened last week, you need to remember where SoftBank was 3 years ago. In nurture, SoftBank's Vision Fund became the most scrutinized and ridiculed investment vehicle in the technology world. The fund had raised $1 billion in nurture for on a thesis that was, in hindsight, correct, but early artificial intelligence would remake the global economy, and the company's position to dominate that shift deserved massive early capital.
The problem was execution. The Vision Fund bet on WeWork, a loss-making office-sharing company whose founder believed he could elevate the world's consciousness. It collapsed in spectacular fashion in Nitan Sejuden. It bet on Didi, China's ride-hailing giant, which Beijing then effectively destroyed through regulatory crackdown after the company's Nitan Ashok IPO. It bet on Greensill Capital and Katera, both of which went bankrupt. Vision Fund E, the follow-on vehicle, has posted a cumulative loss of $10 billion.
In the fiscal year ended March the Vision Fund posted a 13 trillion yen loss. In the following year it lost a record $30 billion. Combined, those 2 years erased roughly $6 billion in value.
Masayoshi Son, SoftBank's founder and chief executive, went quiet. He made almost no public appearances. In a rare Nissan interview, he admitted something unusual for a Japanese executive of his stature. I was embarrassed. I lost confidence.
But he didn't stop investing. Masayoshi Son began reallocating capital toward artificial intelligence with what his team would later describe as total offense mode. The key move was OpenAI. SoftBank made its initial investment, then followed with a February Ishenrslu commitment to invest an additional $30 billion in OpenAI through Vision Fund. To fund this, Son sold SoftBank's entire $5 billion stake in Nvidia, a position that had itself tripled in value over the prior 3 months.
He sold Nvidia to buy more OpenAI. At the time, this looked like an unusual trade. Nvidia was delivering real, audited quarterly revenue in the hundreds of billions of dollars. OpenAI was a private company whose valuation was entirely contingent on continued AI momentum and future monetization. Several analysts flagged the concentration risk. In March, S&P Global Ratings revised SoftBank's credit outlook from stable to negative, citing exactly this: the company was betting too much on a single unrealized private asset.
Then OpenAI's valuation went from $10 billion to $10 billion in 5 months. And the critics got very quiet. SoftBank also holds ARM Holdings, the British chip designer whose instruction set architecture runs roughly 2% of the world's smartphones. SoftBank owns about 2% of ARM. The company just reported fiscal year Nishruk revenue of 2% of ARM, up 9% year on year, with 4 consecutive quarters of over $1 billion in revenue. ARM's long-term target is $10 billion in annual revenue by fiscal 2023.
This is the second most important asset in SoftBank's portfolio, and in almost any other context it would be the headline.
This week, ARM was not the headline. SoftBank's earnings are Japan's most dramatic corporate story in years, but they also reveal something specific about the structure of Japanese capitalism that gets underreported.
Western coverage tends to frame SoftBank as an anomaly, the wildcard in Japan's otherwise consensus-driven corporate landscape. And it's true that Masayoshi Son, born in Japan to a Korean family, educated partly in the United States, and operating in a style closer to a Silicon Valley founder than a Tokyo salaryman, is not typical of Japanese corporate leadership.
But the underlying pattern, concentrated, patient, conviction-based capital, is more Japanese than it appears. Japan's large institutional investors, the insurance companies and pension funds and banks that sit at the center of the keiretsu system, have historically held equity stakes in partner companies not for short-term returns but for long-term relationship stability. The logic is different from Son's, relationship capital versus visionary capital, but both share a willingness to sit with a position through years of mark-to-market losses that would force a Western fund manager to liquidate.
Son took Vision Fund losses that would have ended most careers in Western finance, and he emerged having made the largest single-year profit in Japanese corporate history. That is, in a distorted way, the keiretsu playbook applied at venture scale.
There are real risks here that should not be minimized. 92% of SoftBank's gains came from a single private company whose valuation is based on projected future revenue, not current earnings. OpenAI is spending at extraordinary rates to build and operate frontier AI models. The path from Heki $0.0 billion valuation to actual distributed profits to SoftBank investors involves a series of steps. Regulatory approvals, IPO timing, continued model dominance that are not guaranteed.
S&P's negative outlook is not a coincidence. It reflects the genuine concern that SoftBank has leveraged itself into a position where if OpenAI disappoints, the company's financial position deteriorates sharply.
Son knows this. His response is to double down. Project Izanagi, announced earlier this year, is SoftBank's plan to build a vertically integrated AA semiconductor company to compete directly with Nvidia. The budget $1 billion.
The timeline for first processors late Nisen Nistralukden, a separate company called Roze, a reference to the Japanese word for robotics, is targeting a $1 billion IPO in the second half of Nisen Nistralukden. Its stated mission: build autonomous robots that construct AA data centers. Son is also reportedly in advanced talks for a massive data center investment in France.
The man who lost $1 billion and admitted embarrassment is now planning to deploy another $1 billion. Here is what the SoftBank story means this week.
For Japan's corporate narrative, the numbers matter. Every year, the standard frame for Japan's financial sector is cautious, conservative, incremental. The country's megabanks optimize for stability. Toyota's treasury hoards cash against scenarios that may never arrive. SoftBank's
For AI investors globally, the OpenAI valuation trajectory matters. A private company moving from $7 billion to $2 billion in 5 months is not a normal event. It is the result of genuine commercial momentum, enterprise adoption, government contracts, ChatGPT's continuing dominance as the consumer AI interface, but also of significant markup pressure as large investors compete for allocation. The gap between OpenAI's private valuation and its public market equivalent, whenever an IPO happens, will be one of the defining financial events of Nisen Nistruk or Nisen Nistrut.
For Masayoshi Son personally, this moment is about something harder to quantify. He is Lusif Pi years old. He has spent his career making bets that looked insane until they didn't, or until they did. The Vision Fund years were both insane bets that were proven wrong, and then one insane bet that was proven spectacularly right. He said in that Narsinyi interview that he lost confidence.
He appears to have found it again. The question for next quarter is what ought to be $1 billion in new commitments, AI chips, robotics, data centers, looks like when the results come in. Son has now demonstrated that being wrong for 4 years and right for 1 can produce the largest profit in Japanese history. The follow-up question is whether that outcome was the product of exceptional judgment or exceptional luck, and whether the next round of bets can tell us which it was.
SoftBank reports next in August. Until then, the most interesting balance sheet in Japan belongs to a company that a few years ago most people had written off. Word count, 1700. Estimated duration, minutes. Format news flash.